Okay. Ladies and gentlemen, good morning. Allow me first of all to thank the co-organizers for having invited me to lead off this important conference with a talk, albeit in a personal capacity, which combines a factual statement, yes, the euro area is getting stronger again, with an open-ended question, will this lead to a new growth engine for greater Europe that is beyond the euro area to comprise also the region to its east? I intend to cover four elements. Two are more of the half-glass full type, and two are rather of the half-glass empty nature. First, I will quickly demonstrate that the euro area is regaining economic strength after the double blow of the global financial crisis and the euro area sovereign debt crisis. Second, I'll highlight that this adjustment process has not reached its end point yet. Third, I'll underscore that the euro area recovery is leading once again to net positive spillovers for the Central Eastern and Southeastern countries of Europe, to which I will henceforth refer as the CEE region. And fourth, I'll caution that these positive spillovers are not sufficient to reinvigorate economic growth in the CEE region. First, the positive news on the euro area. After 6 consecutive quarters of negative growth, and output still more than 2% below its early 2008 level, the euro area has started to display positive growth numbers again in the second quarter of this year, even though, as you see on this chart, for the calendar year 2013, we do expect still the annual number to remain in the red. The recovery, as I said, has started, and hard and soft data point to a positive third quarter as well, but the upturn remains weak, it continues to be fragile, and it is still uneven geographically. Going forward into next year and beyond, the recovery, however, will become more solid in a dual sense of the word. Now, first of all, it will spread geographically because we will see an increasingly smaller number of euro area countries displaying negative growth. We expect only 2 countries to be in that situation next year, and none of the 18 euro area countries with negative growth in the year beyond. And second, the contribution of domestic rather than external demand to GDP growth will increasingly gain in importance. Now, apart from the ECB's accommodative monetary policy stance and the expected fall in commodity price inflation, which will support real domestic incomes, fiscal headwinds will become less strong, which should help also this recovery process to consolidate. Indeed, after conducting strongly expansionary fiscal policies in 2008 and 2009 to fight the recession, euro area countries have embarked on a fiscal consolidation path from 2010 onwards, in part under the pressure, of course, of financial markets. They have since gone a long way in correcting their general government primary imbalances, as this chart shows on the left-hand side. With nominal budget deficits next year still expected to be rather close to the 3%, though public debt ratios will continue to slightly, very slightly, I should say, rise further next year before then finally starting to decline as of 2015 onwards. But, and if you look at the right-hand side on this chart, compared to all other major economies in the world, however, the euro area is distinctly ahead in terms of its fiscal consolidation path. Meanwhile, unit labor costs have been adjusting downwards in all of the stressed euro area countries, and the latest on the chart on the left is the green line representing Italy. And this result is not just a statistical outcome of so-called apparent productivity gains, whereby the fall in output is smaller than the decline in employment numbers. No, wage restraint has been there. It has resulted in gains in price competitiveness, and which in combination, of course, with some compression in import demand, have led to considerable improvements in the current account deficits, actually reversals into current account surpluses in most of the euro area economies that were under stress, which results in pushing up the overall current account surplus of the euro area in the direction of 3% of GDP over the next year. In addition to these national economic adjustment processes, and I have not covered some other of these processes, like for instance, the private sector balance sheet repair process or the housing market correction that has run its course. But in addition to these country-led corrective actions, considerable adjustment has also occurred in terms of reinforcing the economic governance framework at the European and the euro area levels. As a result of the strengthening of the fiscal rules of the Stability and Growth Pact and the introduction of a fiscal compact in a separate intergovernmental treaty, which also this country has signed, by the way, euro area member states now face much stronger incentives to adopt sound budgetary policies, provided, of course, that this new framework will be strictly implemented going forward. There is also a new macroeconomic imbalance procedure and a better specification of the country-specific recommendations under the EU semester. And all of this represent important mechanisms that will encourage countries to notably adopt competitiveness-enhancing policies. And finally, Europe is making decisive progress towards a banking union. And this, of course, has two key pillars, one of which is the so-called SSM, the Single Supervisory Mechanism, which was, by the way, finally approved yesterday by the Council of Ministers in Luxembourg. And second pillar, the Single Resolution Mechanism, for which there is a Commission proposal on the table of the EU legislators. Now, this strengthened micro-prudential framework of the banking union will, together with the macro-prudential framework that has been created around the European Systemic Risk Board, be far better able to address in future potential sources of financial instability in the euro area than had been possible in the past. And of course, the euro area banking system will be in a much better shape at the start of this banking union, because there is not only Basel III, but there is also this so-called comprehensive assessment of the balance sheets of the euro area banks that the ECB is going to undertake in the coming 6 to 9 months. Coming then to the second leg, the half-glass empty part on the euro area, indeed, notwithstanding the very considerable list of positive news that I tried to convey, the job of repairing the damage afflicted by the past policy errors made in the euro area remains incomplete. As the left-hand panel illustrates here, private sector loan growth in the euro area remains very weak, even after taking into account the state of the business cycle. And moreover, this aggregate figure masks the heterogeneity among euro area countries, with some of them experiencing especially weak credit growth. Similarly, on the right-hand side, unemployment has risen markedly further over the past 2 years and is projected to remain at this very high level in the coming 2 years, with again a few countries of the euro area showing exorbitantly high numbers of unemployment of beyond 25%. Financial fragmentation in the euro area has been reduced, but it remains at an unacceptably high level. Whereas there is a distinct improvement visible and ongoing in terms of the dispersion of government bond yields, as you can see on the right-hand chart here. And also, by the way, on the left corner at the bottom of this spider chart on the left, other elements of this spider chart show, and in particular, the modest improvement is very visible as regard both lending volumes and also bank loan pricing dispersion across euro area countries for the non-financial private sector. And as a result of this financial market fragmentation within the euro area, the transmission of the ECB's single monetary policy has become impaired in some countries, in particular in those countries in which a negative feedback loop existed between the banking sector and the sovereign. And to illustrate this impairment, I'll show you these two graphs, which compare two episodes during which the ECB decided to cut its main policy rates. And the left-hand panel shows the situation after the bust of the so-called dot-com bubble in 2002, 2003. This is the period September 02, September 03, when the ECB overall lowered its interest rates by 125 basis points, which you can see in the red lines. And the blue surface shows how the average rate charged by the euro area banks in their lending to the real economy evolved, and you can see that it evolved very much in the same direction downward with the ECB downward move. Now on the right-hand panel, you see the situation between September 2011 and September 2012, when the ECB was also engaged in rate cutting. At that point in time, 75 basis points in total. And what can be seen from the shape of the blue surface here are two things. One, euro area lending rates did not go down in parallel with the declining red line. And two, in some euro area countries, bank lending rates even moved up instead of down, thus triggering a tightening of monetary conditions rather than a loosening as the ECB wanted to achieve. So, throughout this crisis period and faced with this impairment of its monetary policy, the ECB has been taking a whole range of measures to the benefit of the banking system to indeed ensure a better transmission of its monetary policy signal. And it has done so directly by providing the banks with the necessary liquidity and funding, which they were unable to tap in adequate amounts from the private markets. And the top part of this chart shows a number of these measures. And also indirectly, the ECB has been supporting the funding of banks by intervening in a couple of segments of the financial market, which are particularly important for banks' funding, balance sheets, or loan pricing activity. And the bottom part of this chart shows three types of markets where the ECB has been intervening. To illustrate the effect of the ECB's more recent actions, I reproduce here on the left the same chart I showed you before, the period September 11, September 12, and I compare that with the period, let's say, May 12, May 13, where again the ECB engaged in rate cutting by 50 basis points. And you see that following the announcement of the decision on its outright monetary transactions in September 2012 in particular, the blue area started moving again in line with the red lines as it should be. But you see also that towards the end of this period, again, we saw some divergences between bank lending rates and ECB policy rates, and this led the ECB to engage in forward guidance, but I will not go into this issue at this point in time. To round off this part on the ECB, of course, because of these various measures, we have seen together in our balance sheet, and our balance sheet is the one where you have to look at the ECB plus the national central banks of the euro area who conduct most of the operations. We have seen a massive expansion of our balance sheet, almost tripling between the mid-2007 and mid-2012, and thereafter a decline which has started, which again illustrates that the improvement is definitely underway. But you can see also, as regards the level of our balance sheet, that we are not yet back into a normal situation. What does all this imply for the CEE region? Now, to start off with some facts, it is the case that the integration of the CEE region, and the mayor of Warsaw just referred to it, with the euro area, has been deepening over the past decade, mostly in terms of cross-border financial linkages, but even in terms of trade integration, things have progressed further, as the red bars show here. What these red bars fail to highlight, though, is the emergence of so-called regional supply chains, whereby some countries in the CEE region are increasingly providing intermediate inputs for final assembly in the euro area, and mostly through the gate of the German economy, by the way. And this kind of specialization is being supported by large inflows of foreign direct investment from the euro area into these countries, and as a result, you have technology spillovers that are spurring income growth and income convergence between the CEE region and the euro area. The green bars on this chart show, of course, the rapid rise in the banking sector integration that you all are very familiar with, but you see also that this integration has stalled after 2007, but I should say, because of the measures taken to repair the euro area banking system, because of the liquidity measures that the ECB has been taking, and because of the interest that euro area banks have to maintain their business here in the region, only a small dent can be observed and no grand-scale deleveraging that was feared in the early days of the global financial crisis. Now, I could point to other linkages than the trade and the banking linkages between the CEE region and the euro area, which can cause spillovers. For instance, there is also the important flow of remittances from migrant workers, or the business confidence channel. But with this chart, I just want to draw your attention to a non-bank financial market linkage which works through the channel of the exchange rate. Indeed, the currencies of the CEE region not only tend to co-move with the euro, but they do so with amplified volatility, meaning that a change in the exchange rate of the euro against other major currencies in the world is typically associated with changes in the exchange rates of the CEE currencies in the same direction, but in a bigger magnitude. And note that these exchange rates, of course, are of countries which are floating, at least in a managed manner, vis-à-vis the euro, and not the ones who are very tightly pegged and who, of course, have the spillover from the euro exchange rate. Now, to demonstrate that all these close interlinkages between the euro area and the CEE region result in important spillovers, I plot here two charts which illustrate how euro area output growth is aligned more closely with growth in those economies of the CEE region which have been integrated more strongly with the euro area through either cross-border financial on the left, or trade linkages, as you see on the right, because in both cases you see a clearly upward sloping line. But the euro area shocks have, of course, a strong effect on all economies of the region, and the correlation coefficients that you see on the x-axis there, which range from 0.5 to close to 1, demonstrate that there is indeed a very close spillover channel at work there, meaning that both positive and negative shocks coming from the euro area will have a big impact on the region here. Spillover analysis conducted inter alia by the IMF, but also as the ECB, as shown, confirms two things. One is, of course, that European integration, and in particular EU membership and the European parent banking model, have softened the blow of international capital flow reversals for the CEE region in the wake of the global financial crisis, as I already alluded to. And what we saw after 2008 was not the kind of big crisis in the region here as we witnessed it in earlier decades in, for instance, Asia or Latin America, notwithstanding the very, very large imbalances, domestic as well as external imbalances, which were present in the region at that point in time, 2007, 2008. That's the first main conclusion. Second conclusion is that the spillovers from the euro area to the CEE countries have, since the creation of the euro, overall been distinctly positive in nature. There's only been one exception, basically, and that's the period between the summer of 2011 and the summer of 2012, where there was a negative influence of the euro area on the region here. And looking forward, against the background of the ongoing adjustment and repair process in the euro area, which I referred to earlier, the spillovers from the euro area onto this region will indeed become even more positive once again. Does this imply that the CEE region in any event can look forward to a bright future? Well, unfortunately not, I should say. If you look at the latest IMF World Economic Outlook figures, which came out only 10 days ago, they show growth in the CEE region to be 2.7% next year. It's almost double of what was last year, but it's still a long way below, for example, the 2011 figure, which was 3.4%. And for the CIS countries, growth next year is projected to be the same as last year, that is 3.4%, sorry, but it's also distinctly below the one for 2011, where we had 4.8%. And moreover, as I mentioned, given the very gradual recovery of the euro area, the CEE region should not overly count on its big neighbor to boost its fortunes. And rather, I would say, the famous Ohio principle will need to be adhered to by policymakers. And by that I mean own house in order, Ohio. In other words, in order to sustain stronger growth, the CEE countries will need to each pursue the needed macroeconomic and structural adjustment efforts that will, in particular, enhance their price as well as non-price competitiveness so that they can benefit more in terms of the contribution that global demand can bring to lift their output and income levels. And accomplishing this objective will, together with this repair process that is underway in the euro area, indeed create favorable conditions for turning the entire region of Europe into a stronger and mutually reinforcing growth engine. But I should say, and as a prudent central banker, you would not expect anything else from me, I guess, is that this is going to be a very challenging task. Because when we look at what happened to potential growth in both the euro area and in the CEE region, we see that as a result of the crisis, all factors of growth have had a severe hit: labor, capital, total factor productivity. And we know that it will take a lot of structural reforms to reinvigorate each of these different production factors, and that such structural reforms, by the way, will not pay off immediately. So the question mark that I had in the title of my presentation, can a new growth engine for Greater Europe emerge, is therefore a warranted question mark. But I would like to end on a positive note by saying that Europe has overcome a lot of other challenges in the past, and I'm very positive that this will happen also with this big challenge, provided all policymakers, as well as all other economic agents, including you here in the room, are ready to take up this task. Thank you for your attention.